Nokia stock is trading live at €8.22, holding a steady intraday positive movement of approximately 2.26% as market participants react to shifting tides in global telecommunications infrastructure. Most retail observers assume that traditional telecom hardware vendors like Nokia are slow-moving legacy giants trapped in low-margin carrier equipment cycles with little room for explosive upside. The underlying reality, however, points to a massive structural pivot toward data center interconnects, optical networking architectures, and high-performance private wireless deployments designed specifically to feed the insatiable data consumption demands of modern artificial intelligence workloads. While the broader public assumes that Nokia is just an old name remembered for durable mobile phones of decades past, institutional desks are quietly accumulating positions as network operators modernize their core infrastructure to handle next-generation traffic patterns. When comparing market expectations to operational reality, the divergence becomes glaringly obvious. The consensus narrative dictates that telecom equipment spending has plateaued globally due to mature 5G rollouts in Western markets. Yet recent corporate updates reveal that advanced artificial intelligence orders and next-generation fiber rollouts are accelerating, doubling specialized segment revenues and proving that the core business is transitioning into an essential backbone for enterprise intelligence. Comment below how many shares of Nokia stock you currently hold in your portfolio. To understand why this disconnect between perception and reality exists, we need to look closely at recent trading volumes, institutional accumulation patterns, and macroeconomic pressures shaping the European technology landscape. Daily swings over past trading sessions indicate persistent buying pressure, particularly following recent quarterly earnings reports that demonstrated an 8% rise in net sales year over year, alongside a significant doubling of artificial intelligence-related network revenues. Trading desks have noted that institutional block trades are stepping in whenever minor pullbacks occur, signaling strong conviction from long-term capital allocators who see the company not as a stagnant hardware supplier, but as a critical gatekeeper of high-speed data transit. Macroeconomic conditions, including shifting interest rate expectations by major central banks in Europe and North America, have also lightened the debt servicing burdens on major capital-intensive industrial players, giving Nokia ample financial flexibility to maintain robust research and development spending without compromising its dividend distributions or balance sheet health. Retail investors utilizing platforms like Schwab Intelligent Portfolios or exploring various online investment options often overlook international equities, preferring domestic megacap technology names. However, seasoned participants looking at online investing frequently diversify through self-investing avenues, using tools provided by interactive brokers, individual brokerage accounts, or specialized platforms like Fidelity, where global equities can be accessed seamlessly. Through Fidelity Investments, Fidelity ETFs, and Fidelity Mutual Funds, or by utilizing the Fidelity Brokerage Interface and the Fidelity mobile app along with the Fidelity Trading Platform, retail participants are slowly waking up to international value opportunities that traditional domestic scanners miss entirely. Similarly, modern traders operating via Robinhood stock trading on the Robinhood app or exploring Robinhood investments and Robinhood fractional shares are beginning to recognize that global infrastructure plays offer a compelling alternative to domestic tech hype. Other market participants favoring SoFi Invest, SoFi Investing, SoFi Stocks, SoFi ETFs, SoFi Robo-Advisor, SoFi Active Investing, and the SoFi Trading Platform have also noted the increasing chatter regarding telecommunications infrastructure adapting to enterprise AI demands. Looking back at the historical evolution of the company, it is fascinating to remember that Nokia Oyj was originally founded way back in 1865 as a humble pulp mill in Finland, eventually expanding through rubber manufacturing and cable production before cementing its legendary dominance in mobile telephony during the late 1990s and 2000s. After selling its once dominant handset division to focus purely on enterprise networking, telecommunications infrastructure, and intellectual property licensing, the corporation underwent a painful multi-year restructuring. Traditional analysts spent years writing off the firm as a commoditized hardware player, vulnerable to fierce margin compression from low-cost Asian competitors. However, that historical narrative ignores the deep intellectual property moat the company built through Nokia Bell Labs, which holds foundational patents spanning generations of wireless standards, optical transport, and secure routing technologies. By monetizing these patents aggressively and simultaneously restructuring its business segments into network infrastructure, mobile networks, cloud and network services, and Nokia technologies, management successfully transformed a struggling handset relic into a diversified powerhouse of digital connectivity. Examining the future outlook reveals multiple potential scenarios, catalysts, and risks that every forward-looking market participant must weigh carefully. On the upside, the accelerating integration of artificial intelligence into enterprise operations requires massive upgrades to data center interconnects and optical fiber backbones, an area where Nokia holds specialized technological leadership. As telecommunications providers around the world begin the multi-year cycle of upgrading to advanced optical line systems and preparing for eventual 6G network architectures, order books could experience sustained upward revisions that consistently surprise bearish consensus estimates. Furthermore, ongoing expansion in private wireless networks for industrial campuses, public sector logistics, and defense communications provides a high-margin revenue stream insulated from traditional consumer carrier spending cycles. On the downside, risks remain, including potential macroeconomic slowdowns that could delay capital expenditure decisions by major telecommunications operators, intense global competition in the radio access network space, and regulatory hurdles across various international jurisdictions. Yet, when weighing these risks against the current valuation metrics, the market appears to heavily discount the company's stabilizing operational cash flows and its strategic positioning in the broader artificial intelligence hardware ecosystem. To summarize the core insights, the market narrative surrounding Nokia stock has long been anchored to outdated memories of mobile phone obsolescence and sluggish carrier spending. The deeper reality uncovered through recent financial performance, institutional accumulation, and a successful strategic pivot toward high-speed optical and artificial intelligence network infrastructure points to a fundamentally different enterprise. By bridging the gap between conservative expectations and the reality of accelerating enterprise connectivity demands, the company demonstrates the kind of structural resilience that rewards patient analytical capital allocation. The contrast between what the crowd assumes and what the financial statements actually deliver highlights why a thorough examination of global infrastructure assets remains essential for anyone navigating modern equity markets.